Welcome back to another episode of Back and Forth with Blue Ridge Wealth Planners. My name is John Vandergriff. I am one of the owners and wealth planners here at Blue Ridge Wealth Planners. I am joined as always by
Zach Hill.
Zach Hill.
Operations team lead and portfolio manager.
Yep. And Zach is a man of many talents. Zach, if you don't watch on YouTube, has an excellent ponytail.
This is a man bun.
Okay, well, everything. My daughter's hair is not too much shorter than yours, so I would consider hers a ponytail. But
okay.
You got a new tattoo?
Yeah.
You still own Remedy Coffee?
Yeah.
How's Remedy Coffee doing?
It's this morning I was there before work and put more chairs out for our customers. So we're back.
We're back,
baby.
Well, and so what we're going to do today is talk about a topic that could affect Remedy Coffee, just like it affects many of you, and that is a topic of inflation. And so again, we want to talk about what it is, what it means, what really is happening, and then how to go about planning for it, because again, everybody's got a little different take on inflation, and again, we'll throw ours in there, but try to back it up with as much logic as possible. So again, simple definition we use for inflation here is too much money chasing too few of goods. That's the Bob Fugit definition, which I think is pretty good. And again, if we've learned nothing else over this last year, we should expect inflation because the economy stopped, which messed up a lot of supply chains. But then also we threw way more money into the economy than we had before as far as stimulus checks. So simple definition is holding up from 2020 to 2021, which is why we saw in April of this year the CPI increase from what they were estimating to be about 3.6%. It ended up being 4.2% from the year prior, which doesn't sound like a huge increase as a percentage.
That's substantially higher than it's been in a long time.
Yeah, and so again, it's one of those where it's much higher inflation than we've had in a long time, but not the highest we've ever seen.
Right.
So again, as we look at that, Zach, what things do you want to use to help us kind of round out the way we need to look at inflation today?
Right. So every time people talk about inflation, they just talk about prices in general, and it's really hard to think about what that actually means. Mm-hmm. So within the inflation report, there's a lot of different components to it that impact that number. I mean, the government's actually measuring a basket of goods and seeing how those prices are changed year over year. And so, for instance, this one is really easy to think through, is one of the components of the headline CPI number is energy prices. Well, like you mentioned, and we mentioned on this podcast, a year ago, is oil was priced negatively. So any positive price change is just infinite, because you're going from a negative price to a positive price. So any price of oil that was above zero was going to create a huge inflation print and have a tremendous impact on that, because you're just going up so much from last April. So, for example, oil priced at negative $30 a barrel versus oil priced at a positive $65 a barrel is a $95 a barrel increase, which is, from percentage terms, infinite, because you're going from negative, but that's a huge increase that we're talking about year over year.
Yeah.
And that's one of the components. But as we start to peel back the layers of things, there's also some other things that are very that are, you can actually just look at and say, well, that's interesting. And we've talked about it before, there seems like there's a shortage on everything right now. There's shortages everywhere. I was talking to one of my friends last weekend, and he builds cabins, and he had a huge deck on his cabin he was showing me, and I was like, oh, that's a really nice deck. And he said, well, it was going to be for a hot tub, but there's a hot tub shortage. I didn't know that. So the other things that go into this CPI print were things that there's a huge shortage of right now. For instance, the biggest component of this was used car pricing from last year to this year.
Right.
Used car prices were up 10% from last April to this April, which is the largest increase since 1953.
Wow.
So we're talking about a number that just beat a 70-something-year-old record from last year to this year. And the car price increase is because there is a used car shortage. There's a car shortage. It is only supply and demand. There's not something in cars that are making them inherently more valuable going forward. Cars will depreciate and eventually be worthless. You use them and they become worthless. But because there's a shortage and they're not able to make new cars right now, that is persisting right now, and that's only supply and demand. We just had a big supply shock. We had the demand actually did increase a little bit. Low interest rates and supply and stimulus checks helped demand, but supply just really had a huge negative shock there, and that increased prices. So we've seen that across the board. We see that with lumber right now. There's been a huge increase in demand for lumber, and supply is pretty much maxed out. We can't get any more supply. So I don't think that it's really
well, and a lot of that, too, is not that there's not wood. There's not the ability to process it.
Exactly.
Make it lumber,
Yeah, there's not a shortage of trees. There's just not enough capacity at the lumber mills to process it and turn the trees into actual usable 2x4s. And so it's things like that shouldn't exist forever. But right now, just because the economy just went to a full stop. I mean, we had negative 30% GDP growth, and then this year we're going to be potentially for the full year at 8 or 10%. We're talking about something that when you compare those two, and we're looking at specifically this time or April 2021 to April 2020, these numbers are going to be off the charts. It's going to be like that probably for May and June too.
Would you think? I mean, knowing what we know from April 20 to April 21, would you say in some aspects maybe you're surprised that number wasn't higher?
I am actually really surprised at that because like we've talked about, it seems, there's a shortage everywhere. Prices are increasing across the board, even in, rents and housing prices increasing. So 4.2% really is not that high. Like you mentioned this relative to history. In the 70s and 80s, inflation was 10 or 15%, and every now and then, there were a couple of readings that were pushing 15%.
Yeah.
And so 4% is double what we've seen over the average of the last 30 years, but is still relative to where we have been in history, is something that's not really that high. But I think there's a lot of reasons for that. For instance, wage growth is still really, really low. We've talked about before, if minimum wage increases, that could put some pressure on inflation. But overall, wage growth has been a primary driver of inflation in the past. So that is pretty subdued right now. So there are other things that you can point to and say, like, this is, there are reasons it wasn't higher, but it did surprise me. The other thing, but one of the things that economists look at is core inflation, and so what the core inflation number is versus what they call headline inflation is core inflation excludes energy prices and food prices because those tend to be extremely volatile. They can be seasonal at times, especially food prices can be seasonal. So we strip those out, and you can get a much smoother, real picture of what's going on. And so when you look at core CPI, it was actually the highest it's been since the 80s, and so that shows us that there is actually some underlying inflation pressure here.
Yeah.
And as you alluded to in the opening of the podcast, is a lot of that is people have been saving money for the entire pandemic, and they were getting paychecks. The personal savings rate was up at 30% at one point. Yeah. And it has really hovered in the 20 to 30% range, where historically has averaged between 5 and 10%. So people have saved money, and now that they're spending it again, prices are just going, and demand is going through the roof. And so,
and I'd say on the short term, that will look to continue because with such a lack of supply, there are people that would normally be buying things right now that know the supply is crazy and aren't even trying.
Right.
So it will be one of those where you'll start to get a supply boost, but the demand will start to pick up just because of the segment of the marketplace that's like, okay, now there's stuff, I can buy it. It's kind of like, we've had the oil issue here locally with the Colonial Pipeline, and people just crazy buying gas for like a day and a half, you know, and there's like some segment of people that are like, yeah, I know that's crazy, so I'm not going to buy anything, but they have to have gas at some point.
Right.
You know? So there's always that aspect of things that exist. And so as we look at this, I think, you know, what you hit second there, the rise in core CPI does show that we do need to pay attention to this. It will be something that will have more staying power, just not as much as it's showing right now. Do you feel like that's a fair statement? Or
I think inflation, the threat of inflation is realer now than it's been in the last 30 years.
Yeah.
And I mean, if we're not going to get inflation now, it's hard to see what could cause it. Mm-hmm. But still, we're talking about, like you said, if we're looking at a core CPI of 2.5% to 3%, that is substantially higher than the 2% that it's been, if you're thinking about it, but it's still really, really low. So we're in this weird split where we potentially have inflation, could see inflation coming, but it's not really high relative to history, but it's high relative to recent history. So it's this weird dichotomy of, yes, there's inflation right now, and that could actually have a little bit of staying power. It won't be as high as it is, you know, the next few months. It wouldn't surprise me if May's inflation reading was 4.5% to 5%. That wouldn't surprise me, but going forward, it could be a little bit higher than the trend has been recently. I mean, that's a significant possibility. But the underlying factor to all this is if wages increase, that is what causes sustained periods of inflation. So we've talked about minimum wages, but wages across the board, if they increase, then we could see substantial inflation. But I don't know. This is an anecdote that I thought about as we were talking about. Is I talked to my dad. My dad is a car dealer. My entire family is in the car business. My dad has 3 dealerships, and I asked him, I said, when are you expected to get cars again? And he said that the manufacturers told him it would be 2 years before he would see normal supply. So if that's the case, this used car print could last a couple of years.
Yeah.
But the market is not expecting inflation to last very long at all. The market measure for the 5-year expectation of average inflation is 2.6% right now. Mm-hmm. So a 5-year average of 2.6% would be a lot higher than 2%, you know, if you're thinking about it, but it's still, I don't know.
How does that, and you may not have this, but how does that compare to where that inflation expectation was maybe at like January? Do you have that?
I have. So last March, the 5-year, they're called break-evens. The 5-year break-even, it measures the inflation rate that tips are paying. The 5-year break-even was 0.16% in March of 2020. In January, let's see, it was 2%, and now we're at 2.6.
Yeah.
Historically, it has averaged anywhere between 1.5% to 3%. It has been really tight in that range. So 2.6% is lower than it was even back in 2011 at some points in time. So if we're looking at the break-evens, they really don't look that out of whack. But what they're saying is short term could be really, you know, we could see some really high inflation prints right now.
Yeah. Yeah, and I think, I mean, like we had alluded to, all of the current events point to this trend continuing. It's just a matter of, you know, how long-term is this? Because, like, you know, to talk about wage increase, you see a very substantial amount of now hiring signs in, like, fast food and everything, and largely because that demographic is still on federal unemployment assistance. And so it'll be interesting to see as that shift changes, you know, that wage base, you know, may go back to work, you know, at a lower than what most people are expecting wage now.
Right.
But again, it's just, there are lots of things that are going on right now that may not continue. Because, I mean, like you said, 2 years in the grand scheme of things is not a long time.
No, and cars and other things, like I was by a friend who's in the real estate business and building cabins. There's not an infinite demand for hot tubs. There's not an infinite demand for there could be if
we hot tubs sweep the nation.
If we keep getting stimulus checks every 3 months, at some point I'll buy a hot tub.
Yeah, if you keep getting locked down, you know.
Yeah, exactly.
Soaking in your own pool of stuff at your house, why not? So eventually that demand is what, and you'll hear the word transitory. That's what they're calling all of these inflation prints right now, is transitory, because a lot of people do not believe that it will
that it will be long term. Transitory means that it will be short term, and once we get through the base effect of prices being at zero at this point last year and then some obscene percentage higher this year, once we get over that, you'll take a look and say, okay, well, we know used car prices are eventually going to come down. When supply catches up, those are eventually going to come down. Lumber, at some point, that demand is going to cool off. That was another pandemic specialty where people were staying at home and wanted to build things and improve things and had new hobbies and all kinds of stuff. So at some point, those things will slow down. It's not some infinite loop where it just feeds on itself.
Right. And so now what we want to do is, transition to, what we can do to help guard against inflation. Because again, if we think that inflation will be here in some capacity, it just may not be as rampant as it is now. It would be good to include in what we're looking at strategies of how to fight against it. And so when we come back, that'll be kind of the topic of discussion is, yes, we have inflation in varying degrees right now. How do we go about positioning money to where we help solve that? So,
are you nearing the age of retirement? Is your 401k not looking the way you'd hoped all those years ago? Retirement is supposed to be a time to relax, a time to live. Here at Blue Ridge Wealth Planners, we strive to provide that service and opportunity. We can help you form a plan that will maintain and grow your retirement savings so that you can achieve what you envisioned when you originally set out on this journey. To see where you sit and what you can do to stand again, visit planforeverything.com. That's planforeverything.com. Blue Ridge Wealth Planners. Let us plan for everything so you don't have to.
Welcome back from our break on Back and Forth with Blue Ridge Wealth Planners. We are talking about inflation today and, the ramifications of COVID that we've had on supply chains, but also price increases, stimulus checks, all this coming together, being mixed into a little mixing bowl here. The outcome has been inflation, and we'll get to enjoy that for a little while. So as we look at it from a planning perspective, I want to spend a little bit of time talking about, because I think one of the interesting things just from a short-term perspective is, like, we talked a little bit last time about goals and how do we build portfolios for goals. And I think one of the things that's been really good about, the models that we have here is during interest rate increase that we've seen and some expectation of inflation, we've seen models stay flat or go up, where most of their benchmarks have gone negative. And so we want to talk about pieces that we use to fight against inflation, but also strategies that we can use to, as far as how and where we position money to make sure that we have as much flexibility to fight against inflation. Right. So as you look at it from an investment perspective, and Zach, in his background, obviously is managing portfolios here, but spent a pretty good bit of time managing commodities, in your previous stops before this. So talk a little bit about that and kind of what is reasonable to expect to fight against inflation, what things people think do but actually don't.
Yeah, and I'll touch on the first thing because I think this hits retirees the most, is the absolute worst place to be in inflationary periods is in long-term bonds.
Yep.
Because one of the key components to how interest rates are derived is the expected inflation rate. And so inflation goes up, expected inflation goes up, long-term or yields across the board go up, but long-term bonds especially are hurt substantially worse. I mean, we saw the TLT ETF with long-term treasury bonds hit a drawdown of 20% at one point for long-term bonds. So that's just not where you want to be at all. So I want to take that off the board right there, because you just don't want to be in bonds, and especially long-term bonds. Now, there's another piece of that where diversification in bonds helps a lot. It helps substantially, but you can go shorter on that on the yield curve. You can do a lot of things within your bond portfolio that really helps it mitigate those effects. But interest rates during inflationary periods are going to go up. That's just a formula of how it works. So you say, well, knock bonds out. What are some things that have historically done well when we had inflation? Well, stocks do extremely well during inflationary periods. They have in the past, in the 70s when inflation was at above 5 and 10% at times. Stocks were doing super, super well. Stocks had extremely high returns, and this was on a gross basis, not an inflation-adjusted basis, but stocks had extremely high returns. Earnings growth, I think during the 70s, earnings growth was higher for a decade than it's ever been for the S&P 500. And so we saw companies' ability to grow their earnings, because what happens with companies is they don't eat the cost of inflation. They pass that on to the consumers, and it helps cause inflation, but they don't have a decrease in their earning power at all. They make sure to pass all those costs on. So stocks are doing well, but also, as you touched on, historically the best hedge for inflation is having some piece of your portfolio exposed to commodities.
Yeah.
Commodities and real assets do extremely well during periods of inflation. Commodities are the easiest because we have the most historical data to compare. It's been really tough with other real assets, such as real estate. Is we don't have a lot of real estate data that goes back very far. But I was telling somebody the other day that if you own a home and have a mortgage payment and you have a lot of fixed debt and inflation goes up, that's incredible for you, because your fixed mortgage payment is going to be the same for the next 15, 20 years. And so inflation only helps you in the amount of, the amount that you have to pay back, because what you're paying back is now less.
Yep.
So those type of things are really, really positive. So if you have a mortgage, honestly, there's a lot of complexities that go around that, but inflation can actually help you there, especially if your wages are going up, because if inflation is going up, and it's sustained, and inflation is sustained, that means that we've seen wage growth. So if you see wage growth and you have a fixed mortgage, then you are just paying back, so much less than you initially were as a percentage of your total income.
Yeah, and you've got more that's staying with you,
right?
With that same income.
So those things are all great. Commodities, like I said, historically have done really well during periods of inflation. That's actually really one of the only things that commodities can do for a portfolio is hedge against inflation.
Yeah.
In my opinion, commodities are pretty useless in a lot of ways, because they're commodities. They're used. They don't generate cash flow like a company does or a bond does. They don't pay interest. But what they do is they tend to go up in price during inflationary periods because they're one of the inputs to inflation.
Yeah.
Like I said, energy prices is one of the main inputs. And so if there is sustained inflation, that is probably because energy prices and commodity prices as a whole have gone up.
Yeah, and it goes back to that definition we used. Too much money chasing too few of goods. If you invest in the goods, that's the right relationship you want the money to have to what you're invested in, because it's chasing it and driving the value up.
Right.
And so when the money is not chasing the goods, then, it's not providing much value there.
Right. And so those things are good. Like I said, in the bond world, you want to stay away from bonds, but there are some ways you can kind of help. Like you can hold there's what's called TIPS, a Treasury Inflation Protected Security. So it's a Treasury bond that pays you a fixed percentage plus the current rate of inflation. Mm-hmm. And so as inflation goes up, it's going to pay you more. So TIPS are the traditional way to fight inflation in a bond portfolio. But overall, I think, it's been kind of the case for our portfolios internally, but across the board over the last year, as we've repeatedly said, stay away from long-term bonds for a lot of reasons, but inflation is one of the primary reasons there.
Yeah.
So I think those are kind of the things that we need to take a look at. Is this might be the first time in a very long time it's worth adding some small exposure to commodities. And I say that as a very broad based, because just getting into one commodity is not really ever a good idea because it's so volatile.
Yeah.
We've seen oil or even gold. The price of oil and gold can swing 5 and 10% on a daily basis like it's nothing. It's just it's not a big deal for oil to have a 5% down day. That's a lot of money. So if you have broad commodity exposure, you still get that inflationary protection there, but you don't have to get locked into just a specific commodity. But for the first time in maybe 10 or 15 years is a time where we start to think about what kind of role commodities can play in a portfolio.
Right. And I think as we start to zoom out a little bit from that and start to talk about ways that you can help position money, let's say you're retired and you're trying to, and I talk about this with people, and you had alluded to this, one of the best ways you can fight inflation is to be employed. Because if you are worth something, and your market value is competitive, that means to keep you in the position that you're at, they've got to increase your pay based on what the market dictates that position's worth. When you retire, the responsibility to factor in for inflation is largely on your shoulders because historically Social Security has not given enough cost of living adjustment to keep up with CPI and other measures of, inflation. But then with that not making up, most people's entire income need, then making sure that you position your savings in a good spot for inflation becomes that much more important.
Right.
And so the big thing you have to look at from a practical financial planning standpoint is how much of your money does it take for you to provide the lifestyle you need today? Because if you need 90%, then you only have flexibility on 10% of your money to factor in for short-term needs, long-term growth, inflationary increase, like a lot of different things. And so if you need half of your money to provide your income today, that other half has a lot more flexibility where it can be invested in, like you said, either commodity type investments, market-related, stocks and things of that nature to where you can have that flexibility. But it's just too many people are kind of missing the point of a retirement plan today because it's investing in the stock market gives you a lot of things, but one of those is not usually consistency on your income.
Right.
And so when people get to a point where they say, I want to invest my money in the stock market and it's going to do all these things, and really when you look at a majority of investors only using stocks, bonds, and cash, it's putting all the pressure on the stock market to be this end-all be-all piece. And it will until it's not. It's just, there are over time, stocks should keep up and help bolster against inflation, but there have also been times where they haven't. So
what you get when you invest in stocks 100% of the time is volatility.
Yep.
And so if you're in retirement, volatility is
your enemy.
Yeah, exactly.
Although some people say, well, I want upward volatility.
I would love that.
Always.
Yeah. I would.
So no volatility isn't necessarily the answer because that means you're not going anywhere. You're just flat.
Right.
But yeah, so as we look at that, that's the big thing is understanding what you need from an income perspective. A lot of that, people don't like budgeting, but a lot of it is just understanding what it is because like you had talked about, one of the worst plans possible from a very practical standpoint is, let's say you set up a situation for retirement. You say, I need X dollars a month. You set up your investments to do that. You start pulling that much money out. It's more money than you need. You start building up a huge bank balance because you're taking too much from your investments. And what you've done is cannibalize any potential for return on that extra money. And so by not being a good steward of what you're spending on a monthly basis, you're actually robbing your inflationary protection because you're taking it out of any kind of investment is going to have more potential today than a bank account will. And so by not honing in on what the need amount is and letting that be a relevant number, again, it's one of those where we want to make sure you're honed in on what that is, and then we can dial in what percentage of your money we can efficiently position to provide that, and then how much can we get flexibility on for not just inflation, but long-term growth, liquidity management so that we can have monies available in case you have an expense that's larger than what your monthly draws are.
Right.
So it's just that starts to get so practical that, most of the time when people have had the lack of concern for inflation for a long time, it doesn't have a place in a portfolio anymore. It's like, well, we're not having inflation. Let's just take that money we would normally put there and we're going to put it in this market piece that's, a 10-year or longer need bucket. And it's like, well, we can do that. But now, like you said, it may warrant starting to add commodities or things that are directly linked to inflation, into the equation. So, yeah. So anything to add to our discussion there?
No, I think you touched on this, and I said this earlier. As I said, one of the worst places, and maybe the worst place you can be for inflation is long-term bonds. But maybe, and this could be an argument to be made, but maybe what should go in that number one spot is a bank account. like you said, bank accounts will continually lose money over time because, like you said, people say they want upward volatility. Well, if you stick it in a bank account during a period of inflation, you're only getting the downside of volatility because every single year you're just losing that purchasing power. And so that's another thing to think about is that doesn't seem to be very practical because your balance in a bank, if it's $100, it stays $100 till you take money out. Well, if you take it out 5 years later, that $100 will buy you a lot less. And so the inflation just eats away at that purchasing power. So having a plan where, like you said, you can get some element of growth that protects you against inflation so you can keep the same spending and purchasing power that you have now so that inflation doesn't just continually eat away at your money, because preservation is not only about making sure that, you can live a confident retirement today. It's making sure that you can live confidently in retirement for the next 10 or 15 years.
Yep. So hopefully this has helped you understand a little bit more about what we're hearing about inflation, but also how you can respond to it. And I think the message that you're hearing from today is that inflation will be a factor. It may not be as much of a factor as we'll see on the short term, because of all of the complications that come from shutting down your economy a year later. It's not just immediate. It's going to be some things that have to work themselves out. But I think, as we look at this, it will be one of those where, adding that component into a plan is now starting to make more sense than it has in the last, 5 to 10 years. And so, being aware of that, but also having someone that you can talk to and walk through that discussion with you, I think is wise. And so, if you want to get more information about us, Back and Forth Podcast is definitely the place to go to get show notes and maybe some articles, because I know you had an article that you referenced with, CPI and different things. So we've got that information, obviously more shows that we've had, but also if you'd like to get more information about how we can potentially help you in these areas, we would be happy to do that. So as far as this episode, though, that's all we have. Thanks for hanging out with us, and we look forward to being back and forth with you another time.
Investment advisory services offered through Blue Ridge Wealth Planners, a registered investment advisor. Securities offered through Madison Avenue Securities, LLC, member FINRA, SIPC, MAS, and Blue Ridge Wealth Planners are not affiliated companies.